Hi, folks. How was your extended weekend?
Yes.
So I've seen this a couple times. So Olivia has one and Chandler has one. What are the roses for? Or in the quad? It's just to have a rose, take a rose. That's cool. Okay, well, that's cool. That's cool. I wouldn't have asked if it just been one. It's like, oh, a rose, but like multiple people carrying them. It's just bizarre. All right, this discussion's already off on an awkward foot. Chapter 4 homework is due on Friday. Please make sure that you're aware of that. We're going to wrap up chapter 4 today. I have some announcements that are relevant for Friday as well. Hopefully, you know by now, after the many emails Dr. Caden has sent out very diligently, that we have Meet the Firms coming up on Friday. And I would hope that everybody in this room plans on attending that, as it can only be upside and benefit for you. This is also an extra credit opportunity for the course. If for some reason you cannot attend Meet the Firms, and you need to do another opportunity, there's the Career Expo later in September. But considering I know everybody in this room is an accounting major, there's not a reason to not to go to an accounting networking event. Yes.
What do we have to do the show that we went?
Tell me that you went.
Okay.
They'll actually record a registry, but I'll follow up if your name's on there. So did you attend Meet the Firms? And so yeah, there's a lot of trust here. So here's an interesting dilemma. Okay. Dr. Barnes is basically giving you grace on this and saying, if you just need to tell me that you go. So you cannot go and then tell me that you can go. The problem is, does that violate ethical principles in doing that? It's like, this is a trick question. Probably so. So I would encourage everybody to attend Meet the Firms. Also keep in mind that if you plan on opting out of the final exam, you do need to complete the extra credit assignment. So whether it's Meet the Firms or Career Expo, I'd encourage you to do one of those two. If not, you cannot opt out of the final exam, which is a big benefit of any course that I teach. Also on Thursday before Meet the Firms, there's the Accounting Careers and Information Panel being held by Beta Alpha Psi from 4:30 to 5:30. So that's tomorrow. I say Thursday before Meet the Firms. That's tomorrow night. It's a good idea to attend to learn a little bit about what accountants do and what the expectations. Do all accountants do taxes? Answer that's just an insulting question. Actually, I've had friends that are like friends of mine from high school, so 30 years friends, and they're just kind of like saying, so you just do taxes all day? It's like, yeah, that's all I do. I do taxes all day. But to answer some questions, can I actually count beans? What a great question that one is. And then, so by the way, this is a good opportunity for you to get that professional interaction required for this course out of the way. You can write up on that particular event. Another opportunity I thought I'll mention, it's including the email, is next Wednesday before this class. There's actually the Innovation Lab presentation with Cody Sumter. And if you have interest in the entrepreneurship, then this might be a good opportunity for you to take advantage of that as well. Again, I'm going to try to mention a lot of these opportunities because I know that they may not necessarily meet with your schedule. So if you can attend one of them, I encourage you to do so. And if you can't, then there will be others that will come up. Today, we're going to finish up chapter 4. We're going to talk about risk. This is probably the most entertaining of the lectures. And it's only half the class period because we start talking about something that everybody loves talking about. But we'll get to that here in just a second. So let's talk a little bit about the nature of misstatements. So we've already talked about misstatements in the financials, and we really haven't clarified what do we mean by misstatements. Now, the term itself is pretty obvious. When I'm saying misstatements, it's obviously something they state a certain amount or a certain fact, and that statement is incorrect for whatever reason, whether it's quantitatively incorrect or it's qualitatively incorrect. Primarily, we're going to focus on the concept of quantitative correctness because we're going to be testing the amounts that are included in the balance sheet and the income statement. This could apply to statements that are made like in disclosures. The term misstatement could just be a qualitative attribute. It would be hard to assess materiality on that because how do you determine if something's materially incorrect in a disclosure? That being said, for our purposes, we're going to keep it fairly simple and try to assess this in terms of monetary amounts. But the question is, how do misstatements take place? And the answer is one of two ways primarily. First of these is called unintentional misstatements or mistakes or errors. These are unavoidable. They're simply because we are humans. You may say that computers do a majority of the counting, but humans are responsible for creating the computers and controlling their input. And if a human makes a mistake, the computer cannot necessarily always correct that mistake. So there's the mistakes and errors. So if the first type is unintentional misstatements, then probably the second type is going to be intentional misstatements. Does anybody want to guess what the term that we use for intentional misstatements is called? Fraud. Yeah, fraud. This is where we get into the stuff that's fun to talk about, the fraud, okay? Now, with respect to this course, we're going to be talking about two types of fraud. Now, there are multiple types of fraud beyond this. There's a forensics course at the graduate level, in which we go into a lot more detail on the different types of fraud. But for the undergrad, for this particular point, we're going to be focusing on two types: misappropriation of assets, which is just theft, and then fraudulent financial reporting, which is just misstatement of the information within the financial statements. And those are going to be the two that we anchor on. You could say bribery and corruption also represent forms of fraud, but we're not going to deal with those as much because those aren't nearly as much a focus of an audit. Now, here's some interesting questions for you guys. In terms of frequency of occurrence, which do you think occurs more frequently, theft or fraudulent financial reporting? I hear reporting. Does anybody disagree? Theft. So I guess some people say theft. It's actually about a 10-to-1 ratio. Theft occurs more than fraudulent financial reporting. Okay. Theft occurs very frequently in many organizations. Now, we're talking about material forms of theft. You could actually say theft probably occurs about 1,000 times more frequently. If you go to an internship and do an internship and say, oh, I need a paperclip for this, for my fantasy football stats, technically that's theft. I don't think anybody's going to call it theft to your face, say, whoa, 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 did you reimburse the firm for that paperclip? But you could make an argument that represents theft. But in terms of magnitude, which do you think is going to be higher, theft or fraudulent financial reporting? Magnitude of an individual occurrence. Fraudulent financial reporting. And that is, again, about a 10-to-1 ratio. On average, the reported incidents are about $50,000 or $150,000 for theft, the material incidents. For fraudulent financial reporting, they average about $2 million per incident. So pretty interesting contrast there as far as we're going to be looking at. We're going to focus on both, but both of these are different in scope and dynamic, but we're going to focus on both for this particular course. Now, we're going to get back to that because there's some very interesting things we need to know about how we approach fraud. But I do want to take a moment in here to talk about some other types of misstatements. These are more characteristics of misstatements. It's really, really hard to say this is a type of misstatement. These are also types of misstatements I'm going to tell you about. And the slide says types of misstatements, but these are more characteristics of the nature of misstatements. And so that's going to be three types: factual misstatements, judgmental misstatements, and projected misstatements. Now, these are interesting in that they occur through different circumstances. Factual misstatements say they're misstatements about which there is no doubt. Now, what's an example of a factual misstatement? Let's assume that your company, the company that you're auditing, they currently use an inventory method that is not approved by GAAP. We'll say that they use the inventory method of average cost. Or sorry, market cost, my apologies, market cost. So they use a non-GAAP approved method. You can recalculate their inventory using a GAAP approved method and say their financial statements are misstated by the difference between these two methods. And you know that to be a fact, because if they were using a GAAP approved method, you have the balance that you've calculated. The method they're using is not approved by GAAP. So in fact, they are misstated by that amount of dollars. You could say the financial statements are misstated by $2 million, and that is a factual statement. So that's kind of that's our bedrock. That's what we would like the most as auditors, is to be able to say we have factual misstatements and we know the misstatements are misstated by that amount. Unfortunately, life is not quite that simple. We don't quite get away with that. So then we have judgmental misstatements. These are misstatements that arise from the judgments of management that the auditor considers inappropriate. These are a little bit more subtle and more subjective. For example, do you remember back from 303 with Dr. Shonioa when you had to do the calculations of the allowance of doubtful accounts and you had to calculate bad debt expense, and there were a lot of different ways to do it? One of the more common ways to say bad debt expense is 2% of sales. All right. So let's say as an auditor, we look at that and we go to the client and say, what do you use for your bad debt expense calculation? Say, we use 1% of sales. I said, well, Dr. Shonioa taught us it was 2% of sales. He's the expert. And he's not the expert. But let's say you as the auditor say that 2% seems to be more appropriate based on the history and the lack of collections from the customers. You think 2% is more appropriate than 1%. Management refuses to make that adjustment. So there's a misstatement there that you've calculated. Whatever that 1%, we'll say again for arguments, that's $2 million. You say the financial statements are misstated by $2 million because management has understated its bad debt expense. But it says that it's only 1%. We believe it should be 2%. Is management in fact wrong in this scenario? In the first scenario, we could say management was wrong. They're using an improper method of inventory evaluations for factual statements. They're wrong. Okay. Can we say that this one is an example of a wrong misstatement, an incorrect or the wrong statement? No, because this is management's judgment. Management is making adjustments. They may be biased, but their judgment is that 1% is appropriate, whereas we as auditors believe 2% is more appropriate. So that's a judgment. The other one is called a projected misstatement. And this is auditors' best estimates resulting in the projection of misstatements. All right. So let's go ahead and what would be an example of this? So we're going to talk a little bit more about analytical procedures when we get to chapter 5, but let's say I develop a calculation for what I believe the projection should be. And all right, we'll ignore analytical procedures for now. We'll deal with something else. Let's say that I send out confirmations to a sample of my customer or my client's customers, because I want to know what their balances are for accounts receivable. And so I get some of those back, and some of the numbers that the clients report to me are different. So we'll say they report back $100,000 in differences from what was reported. Now, you note I said a sample of clients. I don't test all the clients of the customers because all the customers, my clients, because my client has literally thousands of customers. So I'm only going to test maybe 100 or so. What does that mean? It means that I've got to use that $100,000 misstatement and I've got to extrapolate that to the population. I've got to actually use that to make a determination of what I think the population is. Does that mean that the population is misstated by that number that I calculate? No, it's just a projection, okay? It's just a projection. I'm using an estimate to determine what I think the true misstatement is in the population. I don't know what the true misstatement is. I don't have the time or resources to test every single client that the customer has, or every single customer the client is. I've never struggled with those two terms, by the way, and I've done it like 3 times, all right? Every single customer my client has, I'm not going to be able to test them. I can only test a sample, and I can use that sample to extrapolate to the whole. That does not mean that the misstatement is going to be what I calculate. It means that that's what I project the misstatement is. So 3 different ways that misstatements can occur. It's important to note that as we move down this, we get increasingly more subjective. We get more uncertainty as we move down because we have absolute certainty up here, and then we get less certainty and very little certainty down here. So the more subjective our approach is, the less reliance we put into the nature of our misstatements. It would be very, very hard to say that if we come down here and we say to our client, your financial statements, your accounts receivable are misstated by $2 million. And they say, are you certain about that? It says, well, that was our projection for it. It would be a lot harder to persuade them to make an adjustment than it would be up here where we can say, we know your inventory misstated by $2 million. You have to make an adjustment. You have to change your methodology for inventory. Okay, let's go back to fraud. Fraud's fun. Yes, talking about fraud is the fun part. Okay. So as part of planning an audit, the auditor performs the following steps to assess fraud risk. Discussion among the audit team members regarding the risk of material misstatement during the fraud. We do a fraud, which we're going to talk about here in just a second. We're also going to talk about inquiries and management of the audit committee and others to view their risks on fraud and how it's addressed. We need to consider any unusual or unexpected relationships that have been identified in performing analytical procedures and planning the audit. We also want to understand the entity's period end closing process and investigate unexpected period end adjustments. This is an interesting one. We're not going to go into a lot of depth, but why are we concerned about period end? What is the reason that we might be focused on that period end adjustment? So let's say that you're concerned about fraud taking place because of it, in prior periods, you've seen fraud in manipulation of revenues and overstatement of revenues. When is that manipulation likely to take place? It's at the period end when they look and they say, we're not going to meet our bonus expectations. We're not going to meet our sales goals. We're going to make up fraudulent sales entries at the end of the period to make up the difference. Has that ever happened in human history? Yes, only a few million times. You know, it's a pretty common occurrence. So if we look at the period end, that was when the most likely occurrence of fraud is going to take place. So I've given you guys a tip. If you ever want to become white-collar criminals, don't commit fraud at period end. Okay, that's when it's most likely to get caught. Commit it during the middle period of the halfway through, or maybe 3/4 through the year, and then avoid your fraudulent entries at year end. That's obviously not what I'm trying to teach you, but you know, this is kind of a lesson in that regard. And we also wanted to identify and assess fraud risk factors, which are going to go into a little bit more detail. All right. By the way, when we talk about analytical procedures, these are kind of different from this is kind of what we're looking for is looking for differences from industry standards. So the relationships, if we see something, for example, A really good example of this was a company called Enron. All right. At the time, their industry was in downturn because of the financial, basically the internet bubble burst right in the early 2000s. So the energy industry as a whole was going very down. They were actually seeing record profits quarter after quarter after quarter. Is that an expectation we should see for a company like that? Probably not. We might have wanted to investigate a little bit further. Also, major changes in trends. If we see a trend that's occurred over time and then all of a sudden something massively different occurs. So our company that our client that we're auditing has cost of goods sold of 30%, pretty stable for the past 20 years. And then all of a sudden their cost of goods sold shoots down to 20%. We'd say, why did cost of goods sold change so much? There might be a reason for that we want to investigate. All right, going to those the stuff that we bolded and highlighted here. Let's talk about this discussion among the audit team. These are generally referred to as brainstorming sessions, and basically they're about the entity's financial statements susceptibility to fraud. The idea behind this is that it's just kind of what you would think of in a brainstorming session in a traditional sense. The audit team meets and says, what are some areas that we need to be concerned about based on the client's history with respect to fraud, and how can we best address those? This is particularly important if previous fraud has occurred in the organization that we want to be able to address or prevent from occurring in financial statements moving forward. So the idea being here is the auditors are going to come up with whatever ideas they can have to address these particular problems. If we believe that there's going to be problems with revenue misstatements, then we might want to scrutinize the period and closing entries or scrutinize the people who have responsibility for those areas. If we think that there's going to be problems with the transfer of inventory or the valuation of inventory, we might want to do extended procedures over inventory. Whatever it is, whatever the particular issue that we identify, that's going to be a focus that we come up with during the brainstorm session. That being said, auditors mean really, really well, but how successful do you think we are at capturing fraud? Of all reported incidents of fraud in public companies, what percentage do you think is detected by auditor work? Just throw out a guess, a percentage. What do you think? 70%? It's lower. What's that? Lower. Lower. 2%, exactly. 2% of all reported frauds in public companies are captured by audits, okay? Pretty discouraging, huh? It's like, oh, auditors are supposed to be able to handle this. No, we're not. Why? Because we're only in there for a short period of time. So what we'd want to rely on is we'd want to rely on the people who actually know the organization, which is why our next step is inquire of management, the audit committee, and others, all right? The auditor should inquire about management's knowledge of fraud with the entity. What management knows, we need to actually have good insight on, because this is going to give us our ability to better to cover the risk of fraud. The entity's audit committee should also assume an active role in oversight of the assessment of risk of fraud. So not only should they be concerned about the financial statement presentation, but they also should be very concerned about what type of misstatements can occur due to fraud and be able to have oversight for those particular concerns. Then we should also consider inquiries from others within the entity and third parties, such as vendors, customers, or regulators. Now, here's an interesting question. According to a poll by the ACCT, which is actually responsible, Association for Certified Fraud Examiners, they were actually responsible for that 2% poll. They did a similar poll and say, what percentage of frauds are detected by external reports or by reports from like whistleblower hotlines from customers, vendors, internal parties? What percentage do you think that was? Close, 50%. 50% of all, half of all frauds come from those sources. So is it important that we probably pull those sources to make sure that those sources have information for us? Because if they do, they're going to be a much better source of information than our own work. All right. Now we're going to talk about my favorite thing to talk about in all of accounting. We're going to talk about Cressy's hypothesis. Some of you may remember this from AIS. We actually talked about it in this AIS. So this is Donald Cressy. He actually wrote the following statement. Trusted persons become trust violators when they conceive of themselves as having a financial problem which is non-shareable, and are aware this problem can be secretly resolved in a violation of position of financial trust, and are able to apply the conduct and situation verbalizations which enable them to adjust their conceptions of themselves as trusted persons with their conceptions of themselves as users of trusted funds or property. So that's a mouthful. But what happened is that Cressy's hypothesis was converted into a much easier to digest format. And that emanated from something that you may or may not be familiar with. Has anybody ever heard of Smokey the Bear? Okay, Smokey the Bear says only you can prevent forest fires. And obviously that relates to fraud, okay? how does that relate to fraud? Well, Smokey also used to talk about how in order for fire to exist, there have to be three components. There has to be oxygen, heat, and fuel. So if you can eliminate one of those, then you can prevent fires. Now we can't get rid of oxygen, and if you're in the woods, you probably can't get rid of fuel. So making sure the heat, whenever you have a forest fire or a campfire, that you get rid of that heat and get it all mashed out and put out, that will prevent the forest fires from occurring. Okay, so that was Smokey was trying to tell. Because we're accountants, we don't do anything original. So we took Smokey the Bear and we took that triangle and we created something new for ourselves. Okay, that's what we call. So sorry, there's the breakdown of those things. So that's what we call the three pieces: incentive, pressure, opportunity, and attitude rationalization. Those underlying words, which again you're familiar with because these are slides almost identical to the ones from AIS. So this is called the fraud triangle. And the idea being is that in order for fraud to occur, these three factors have to be present. There has to be a pressure that cannot really be shared with others. There has to be an opportunity for to take advantage of a situation. And you have to be able to have an attitude or rationalize your behavior. Now let's use a very, very simple example, which is something my students always get a kick out of. Let's assume that in a couple of weeks from now, when we have our first exam, you're just kind of like, I am not prepared for this exam. There's no way I can study enough. I'm going to cheat. Okay. I'm going to cheat. What is the pressure that's present there? You're like, I need an A in this class. I need an A in this class. Dr. Boynes will be really disappointed if I don't get an A in this class. Okay. Putting pressure on yourselves, which you're a Truman student. That's inherent pressure right there. Okay. Inherent pressure right there. What's a rationalization? Rationalization. Dr. Barnes is kind of a jerk. Okay. He doesn't have any sympathy. He gives us technology assignments with technology that doesn't work. Okay. He doesn't teach really well. He puts memes up there like Smokey the Bear and stuff like that instead of actual content. All right. What's the rationalization? Rationalization is that, you know, I'll be okay. I'll be okay. Sorry, that's rational. That was the rationalization. And then what's the opportunity? The opportunity will not be present, by the way, because I'll be watching every move that you make on the exam. But let's assume for a second I pull up my iPad and I'm just kind of like, you know what? Standing here and proctoring exam is boring. I'm going to play video games instead. All right. So I'm looking down and all of a sudden you're just kind of like, okay, he's not paying attention. I'll pull out my notes and oh yeah, that was the answer is. Okay. Don't do that, by the way. Okay. This is not suggestions for you. It's not suggestions for you. By the way, if I do this, if you see me do this, like, oh, so I may have my camera on my iPad and I'm watching you do stuff while you're doing stuff. Have I done that in the past? Absolutely. Not here at Truman, but I have done that before. So all kinds of factors there, and you can relate that to the way business operates. Okay, some of the pressures are implicitly obvious, like if an organization is paying their employees or paying their managers on performance basis, they have an incentive to try to meet those obligations. Other pressures may be a little bit less obvious. Addictions tend to be very, very prominent pressures in organizations, particularly with respect to theft, because people have to actually have money to fuel those addictions. We're going to look at some examples. In fact, we're going to look at one of my favorite cases in chapter 4. One of your problems, your discussion cases, is about a lady named Susak David who worked for Koss. And we're going to talk about a fraud she committed, and it's going to be outrageous. So we'll talk a little bit about that on Friday. But this is the fraud triangle. The fraud triangle gives us the content for how we can actually assess fraud risk in the organization. When I use the term fraud risk factors, what you're assessing is what incentive or pressure exists, what opportunity, if any, exists, and what rationalization or attitude exists with the people who are committing the fraud. As auditors, we only have control over one of these, really. We can't really affect the other two. Which one do you think the auditor has the most control over? Opportunity. And so as such, our focus is going to be making sure that whatever procedures, whatever protocols, whatever controls are in place, they address the opportunity that fraud can occur and try to eliminate that to as much a degree as possible. Some of it may not be able to get rid of. We're going to talk a little bit about bypassing of controls in a few weeks. And we're going to note that some controls can have to be bypassed. There's just no way around it. But if we can minimize those opportunities, then we can minimize the occurrence of fraud within an organization. All right, our final steps. So basically, in the response to the risk assessment, we want to determine whether we need to assign more experienced, specialized personnel, consider whether the entity's chosen policies are indicative of fraud, or incorporate unpredictability in selection of the nature, time, and extent of audit procedures. Now, this one's kind of an interesting one, simply because students hate it when I mention this. Because what would be the most effective way to ensure that people are not going to cheat on an exam? It would be to give you exams unannounced. Pop exam. All right. Everybody pull out a piece of paper right now. I am not that cruel. I am not that cruel. I wouldn't do that to you. But would we argue that that would be an effective means of avoiding you all from cheating? Actually, you may make an argument, say, Dr. Barnes, it may do worse because we'd be so stressed out that we would constantly carry notes on us and we would have no choice but to use those notes to cheat on the exam because you don't tell us when the exams are going to take place. And to that, I'd say, touche. All right. Which is why I don't do that, because I don't want to create stress, any undue stress in your life. I feel I do a good job enough, just my natural teaching already. What about evaluation of the audit test results? Has a material misstatement occurred? If so, we need to talk to management. And if management refuses to make an adjustment for a material misstatement, what are the auditor's options? This is the point where we say, here's where we're going to determine what type of opinion we're going to issue. If there's no material misstatement, we have a clean opinion or an unqualified opinion. If we have a problem, then it could be varied depending on the nature of the problem. We're going to get into more detail on that. We start talking about it, the reports themselves in chapter 18. But for right now, the thing that you should remember is that depending on the nature of the opinion that, or the nature of the issue that's encountered, that's going to be how the auditor is going to address it in their report moving forward. If it's a smaller problem, then it probably is going to be a qualified opinion. If it's a large problem, it'd be an adverse opinion, or in some extreme cases, a disclaimer of opinion if there's information that we can't gather. What about if fraud has occurred? Well, interesting thing about fraud is, for the most part, the auditing standards in this area say that fraud does not have a materiality threshold. Now, you have to take that with a grain of salt. You have to take that, can't just basically say, oh, no materiality. If I catch somebody stealing a pack of gum, I'm coming after them, all right? There is obviously some sort of implicit materiality, but there's not the stated materiality in the audit. If any fraud has occurred, we want to gather evidence of fraud, consider it has implications in the audit, particularly if there's a direct and material effect on the audit, because that constitutes an illegal act. And we want to discuss the matter with the appropriate level of management and or the audit committee. Now, that leads to some interesting statements on this. So first of all, the auditor should document the risk and material statement for all material accounts and disclosures for related assertions. But with respect to communication of fraud, when the audit has found evidence of fraud that may exist, that matter should be brought to the attention of the appropriate level of management. What is the appropriate level of management? Generally, that's going to be the next highest level of wherever the fraud is occurring. So if you're auditing and doing auditing factoring, you notice that people are stealing parts off the factory floor. You want to talk to the line supervisor, say, hey, your employees are stealing stuff. You probably should address that. All right. What about if fraud is occurring at the highest level of management in the organization? Do we report it to the management of the company? Say, hey, CEO, we know that you've been misstating the financial statements for years now, and you got to stop that. Okay. Is that probably likely to be effective if we tell the CEO to probably not. So who do we go to in that situation? If it's senior management and it's fraud that causes a material mistake in the financial statement, should be reported directly to the audit committee. So two criteria there. If it involves senior management, or if it is if fraud that it involves a material misstatement in the financial statements, in either situation, we're going to go talk to the audit committee. So the first one is basically saying there's no higher level, so the audit committee is our next resort. The other one is saying, regardless of the level of that we're reporting at, if it's material to the financial statements, that is something we have to include the audit committee on. All right. And with that, we are done with chapter 4, but we still have something to do. All right. So I'm doing this a little bit differently than I've done in the past, just simply because we have a smaller class size. Like I said, when I first started doing this activity, it was like 30, sometimes 40 students. So we have a little bit smaller class sizes. So here's what I'm going to do is I need a volunteer. I need an external participant to identify where waste break down, which I'll identify. So would anybody like to volunteer? If not, I'll force somebody to volunteer. All right, come on up, Jared. Don't know what you've gotten yourself into. Ha 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 ha. All right, here's what I want you to do. Jared, I want you to stand right over there by the table, okay? Just right there, okay? So you're going to be our observer, all right? And not in front of the PowerPoint, but right there. So because they're going to need to see what's on the PowerPoint. All right. The rest of the class is going to be the wave. Now, have you ever been to a sporting event where you've done the wave like that? Okay. You guys are going to be doing that as a class, all right? So here's what's going to happen. Here's what's going to happen is that I'm going to start. We're going to say start a wave A in a wave. So we'll start the wave with Chandler over here, okay? Basically, what's going to happen when Chandler starts the wave, it's going to move over, okay? And it's going to come over to ZU, and then it's going to start over here. It's going to come over here, and then Nina, it's going to go to Grant, and it's going to end over here. Okay, so let's just go ahead and try this. We're just going to do one wave. Can everybody go to that? All right, go. Yeah, good job. Give yourselves a round of applause. Good job. All right. So obviously it's not that simple. Okay, one wave is just not enough because you never go to a sporting event where there's just one wave. Okay, so here's what I'm gonna do. I'm gonna point at Chandler. Okay, Chandler, whenever I point at you, you start a wave. Okay, are you ready? Was pretty good. I started 5 waves and I think 4 of them finished. So not bad, not bad. Okay. All right. So you guys are actually showing a lot more adeptness and adroitness than some of my previous classes. Sometimes I start like 5 waves and they finish 1. Okay. All right. Would you agree it's looking pretty good, Jerry?
Yeah.
Okay. So let's not rest on our laurels here. Let's actually pump up the intensity a little bit. All right. So now we're going to have multi-directional waves. Okay. So this time the waves will start with Joe if I point with my left hand. All right.
Oh, that's good.
Okay. So here we go. Here we go. If I point with my right hand, so start with Chandler. If I point with Joe, not yet, not yet. If I point with my right hand, start with Chandler. Point with left hand, first to Joe. Ready? All right. So I did 6 waves there, and I think 3 of them finished. Well, why you all are laughing? You're not taking my exercise seriously? All right, come on, come on. This is the legit, okay? So we're gonna do this activity for 5 points now, all right? If you guys finish it, you get 5 points. If you don't finish it, you're gonna get 0, okay? So you have to be serious about this. Ready? Here we go. You all failed me for the last time. All right. All right. So here's the deal, guys. Here's the deal. You did your best, but you just didn't quite get there. Okay. Okay. And never mind the fact that I knew you wouldn't get there because I had this slide prepared for you all. All right, let's talk a little bit about this. Let's talk a little bit about this. So what are some ways that we can improve the process to reduce failure in this exercise? Because obviously this exercise is not designed well. So what are some ways that we could actually improve upon it? What are some suggestions you have? Nothing. It's perfect, Dr. Barnes. We completed every. No, you didn't. It's not perfect. What are some ways? Fill the gaps. That would be a good one. Yeah, have a floor classroom like I move you all together. Like it'd be easier to do in 2 rows. Invite some people in. Have a bigger group. Yeah. Well, I'll actually invite you all back next semester when I do this exercise, and it'll feel like awesome. What about the direction that I started in the back, and was that problematic? So the people who were trying to look back, trying to say, what's going on? So how could I fix that? I can start from the front, or I could do we could do vocal cues. Okay. Anything else? Move slower. Okay. So you're saying like I did this fast for a reason or something. Yeah. Okay. Yeah. So I think we can agree that there's better ways for this whole thing to be designed, correct? This was not an optimally designed exercise. Like that might have been deliberate or something, but we'll get to that. Okay. Let's talk to our observer.
Hello.
And Jared, the observed failure in this exercise is a function of its components. In this case, the students in the class. All right. Can we agree with that statement?
Yeah.
Okay. So here's the deal. We need to address the causes of failure. And you're going to be helping me with that because that's what I'm observing. So option 1, I want you to identify 3 students in the class that you believe are most responsible for the failures in the wave. These students will receive no credits for today's in-class exercises. Today's exercise is worth 5 points. All right, hold on. I realize that this is a challenge, okay?
Yeah.
Okay, because I'm asking you to throw 3 people under the bus, okay?
Yeah.
So I'm gonna give you an option out, okay? I'm thinking of a number 1, 2, or 3, and I've actually got the number in my head. If you guess it correctly, everyone gets full credit for today's exercise. If not, everyone in the class loses 2 points for today's exercise.
Okay.
So you want to do option 1 or option 2?
What do you guys think? Option 2? All right, 2.
What's the number?
2.
No, the number was 1. So everybody loses 2 points. All right. Good job, Jared. You know, could Could have thrown 3 people under the bus, and instead you threw everybody under the bus. All right. Actually, I remember everybody's going to get full exercise, so you can go ahead and sit down. All right. So, regardless of what our observer selected, everyone's going to get full credit for today's activity. All right. That's really not fair for me to do that. But this is predicated on you all answering the following questions. All right. So, this exercise was extremely complex and susceptible to consistent failures. From an audit perspective, what does the WAVE exercise represent?
Company operations.
So yes, you're correct, company operations, but how do we characterize that in chapter 4? How do we characterize the nature of company operations? When we started talking about the business, its environment, and the things that we're concerned about. Because remember, chapter 4 was about the audit risk model. What component of the audit risk model would this be representative of? Business risk is you're on the right track, but one of the audit risk model components. So how do we characterize business risk as auditors? Give you a hint, okay? We have AR, IR, CR, and DR. Which one is it? Not quite. But I appreciate the initiative.
Oh, IR.
IR, it's inherent risk. Yeah, it's inherent risk. So the nature of the activity as I had it set up, that's inherent risk. It was complex and susceptible, and that was deliberate. I wanted you all to fail, okay? Now, I want you to note, this is the only time that I will make that statement in this course, okay? I wanted you all to fail this activity because it teaches an important lesson. As far as everything else in life, I hope you're very successful, okay? Unless somebody else does a wave exercise in another class, which would be silly because it's an audit exercise. But, so inherent risk, you're susceptible to failure, so you know that there's a risk associated with that. Now, keeping that in mind, recall the classroom poll where I asked for ways to improve the process. From an audit perspective, what do these improvements represent? What's that? So not control risk, but just controls. Yes, we know that there are risks present in the activity, and I ask you guys for solutions to those problems. Your solutions were suggestions, those were controls. You were saying, hey, Dr. Barnes, if you do this activity the way you've got it set up, it's not going to work. We know that there are risks associated with that. We have some suggestions to fix that. And I said, all right, let's fill in the gaps. Let's go a little bit slower. All right. Those are suggestions. Those are ideas and that. So this is the relationship between inherent risk and controls, which you already know that because, again, it's been drilled into you since AIS, is that controls are merely a response to a risk. But this relationship is not intuitive unless you think about it in the context of this kind of situation. When an organization is facing problems, they have to be able to identify those problems and address them properly. When we get into the discussion of controls, we're going to get back to that COSO framework, which I know you all love from AIS. Everybody remembers that. So, yeah, COSO. But there's a really important lesson to be taken away here is that if you don't have effective controls, then you can't address those risks that are present in the organization. So that's why we have to consider both the risks, the nature of the risks themselves, and how we address those. Now, control risk is kind of a separate concept. Control risk would basically be saying I come up with a control that either was designed or not functioning properly, which certainly could be the case. I could say, you know what, there's a risk here. Here's what I'm going to do. I'm going to put a lava lamp in the middle of this table up here for everybody to focus on. Is that a control? Yes. Is it an effective control? Probably not, okay? It would be pretty. Lava lamps are cool, okay? But they're not necessarily, I don't know why I use lava lamp as an example. That was right off the top of my head, by the way. All right. But so we need to not only consider whether or not the control is present, but whether it's designed and functioning properly. So those are some concerns as well. Now I want to talk about the thing. You notice that I brought Jared up here and I put Jared in a very uncomfortable position. And by the way, I will say that this happens every single semester and it's always going to be an uncomfortable position for one person. So you're a trooper for standing up for that because I put you in that deliberate situation. But how does this relate to an auditor's responsibility in the real world? All right. The question is, as an auditor, if you go out to be an auditor, are you going to be faced with uncomfortable situations? And now I can use this term, I'm specifically talking about this as an auditor. There are also going to be other situations or other types of accountants. There's actually a vaunted story about the VITA assistants who were working right immediately after the passage of the Tax Cut and Job Act of 2021. So did anybody remember that discussion that was President, I guess it was not 2020, it was 2020, I don't remember what year it was. The Tax Cuts Job Act, it was one of President Trump's initiatives, and it actually reduced taxes overall across the board. What happens when you reduce the amount that people have to pay in taxes? What happens to their refunds at the end of the year? They get less in refunds, okay? So people came in to do their VITA and there's like saying, they were saying, okay, the volunteers were saying, okay, you're getting a $2,000 refund. And then the people were like, no, I always got $5,000 in past years. So like, well, you didn't pay as much in taxes this year. The amount that you paid in taxes is much lower. As a result, the amount that you're getting back is much lower. We actually had people storm out and get enraged and say they're going to HR block. Even had one call our volunteers an idiot, okay? Which was not cool because these are all people volunteering their time. So it can happen in other areas, and that's just kind of an anecdote. I don't want to dissuade you from going tax traps. Like, oh gosh, I don't want to have that happen to me either, Dr. Barnes. I don't want you to dissuade you from that, but I want you to be aware that you're going to have to face pressures, and you have to be able to address those pressures properly. From an audit perspective, this is something that could occur depending on the client that you're set up. Now, the example that I give, when I was in auditing, I went to a client, a large state client. They were actually responsible for running all the 7-Elevens in Texas, but their facility was in Odessa, Texas, which if you've never heard of Odessa, Texas, it's fairly well known because they have big oil company groups out there because they've found a lot of oil excavation. And there's one really, really, really nice hotel, like a 4-star hotel in Odessa, and everything else is like middle of Texas type thing that you consider. Like if you ever watch King of the Hill, exactly like that. Okay. So, yeah, I was working on this client, and the people who are actually at the client, they were very, very local, very rural, very relaxed. There's a old lady there who'd been working for the company for like 30 years, and she was just like very, very cheerful and upbeat. And I'm gonna kind of embellish the story a little bit. I'm gonna exaggerate kind of the story, but the person I'm thinking of, it's kind of the scenario. She was very, very nice and polite. She was very cheerful. She always shared stories with me, even occasionally offered me a piece of candy off her desk. I'm like, ooh, piece of candy, you know. But ultimately, when we started looking, she was not able to adapt to new technologies, and she was missing out on some of the responsibilities that she had for her role. As a result, a lot of the failures that were occurring within our audit were at her feet. They were occurring because of her responsibility. Now, do I personally, as an auditor, want her to lose her job? No, I don't. She was very, very sweet and very, very nice, but I'm standing there thinking and saying, this is where the responsibility is. She refuses to change. She's not comfortable with the technology. She can't do the job that's necessary. They need to replace her with somebody who can do that job. Is that an easy statement to make? Is it my responsibility to make that statement? Because you would think, well, I'm not going to say anything. I'm just going to say, because I like this little lady. She gave me candies, for crying out loud. I'm not going to throw her under the bus. What happens in the future? What if there's a misstatement that's significant to the client and then they get indicted in a lawsuit, or they have a misstatement where the shareholders basically file suit, or they end up having to declare bankruptcy simply because this little lady can't do her job? It's really, really hard to acknowledge what the right thing to do is. And mathematically speaking, the situation that Jared chose was not the correct one. Okay, I'm not judging here because again, I put you in a very awkward spot. But if we think about it mathematically, we're talking about 3 people losing points. That's 15 points total, versus the likelihood that 15 people will lose 2 points. That's 30 points, but then again, it's like 2/3, so it's actually slightly more. Okay, so slightly less than that. So there's a problem with that. The decision is that if we try to go with what the correct value is, it's not always going to be what we want to do. The correct decision is often not the easy decision, is basically what I'm trying to tell you. So keep that in mind, is that you're going to be asked to make hard choices in your career, and it's not often correct. I will say, as a personal result of this, my father, he worked as accountant for a long period of time. He made some decisions that he should not have because he wanted to keep his job, and he was really, really afraid of his boss because the boss was very intimidating, and made some very poor decisions in this area. And if I'd go back and say, you know, it's better to lose your job because you made the right decision than not to keep your job and continue making wrong decisions. I hope you don't ever encounter that scenario, but keep in mind that this is a possibility that come in the future. It's better to make the good decisions and know that you're making the right decisions for the right reasons. That's kind of the big takeaway from this particular section of it. With that, we're done. We will reconvene on Friday for chapter 4 homework. I'll see you guys then.
I thought Jared was usually, that's what I said. I was thinking.